Hi, this is Rahul Sharma here from GM Financial. Firstly, wish you and your family a very happy Diwali and a prosperous new year. Well, Diwali is not only about narratives but an opportunity to unleash in the new year. As we speak, not only is there a relief rally across global equity markets, but at the same time, there has been a significant cooling off in the geopolitical issues that we've seen. Not only crude has cooled off, but we're also seeing a cooling off happening in the US 10-year bond yields. Well, the key to November and the coming months from here will be greatly dependent on how the world is able to navigate across these challenges. Now, speaking of our markets, Nifty did respect the 200-day exponential moving average. On the October expiry day, we did hit 18,838 odd, and then we saw a rally happening in our markets as well. Well, generally, a retest of such a key support level is healthy for the markets technically. Well, not only is this the 200-day moving average, but also the breakout zone of the previous rally that began. So if you remember, there were multiple tops, one at 18,800, another one at 18,900. That area has been successfully tested by the market as a stress test. Now, going ahead, what will also depend is how do the positioning of the market in terms of the aggressive shorts which are held by FIs versus the longs which are held by retail. Does this position flip? Let us decode the markets step by step and see what November has in store for us. So firstly, to begin with, the father of all markets, the Dow Jones index. As you can see in the graph, the long-term trend line has been tested and a bounce back can be delivered. Now, as long as this structure remains intact, we are hopeful that the US markets would chug along in a relatively less bearish way. Yes, the bear market is very much there in the US markets, but going by what the Fed has said in the last meet that they had, at least the rest of 2023 seems like they are done with the rate hikes, and that bodes well for the equity markets. So as far as the US positioning is concerned, it seems like the downside seems to be limited, at least for this month. Well, what has been a bigger problem is Brent oil. We saw this spiking up significantly once the Israel-Gaza conflict arose, and post that what has only happened is a cooling off. Now, the long-term charts are depicting a rounding bottom formation, the breakdown of which is placed at $83.50 per barrel. Well, if this does happen, I think there is a strong case for an continued down move in the Brent oil. So what this indicates is if oil further corrects from here, that should bode well again for equity markets domestically, and at the same time also put aside the sentiment and the fear which is revolving around the conflict. As long as it remains a bilateral conflict, I think the markets will take it similarly to what they took it in terms of Ukraine and Russia, and similarly Israel and Gaza may not continue to bother. So oil remaining below $83.50 per barrel is good news for the bulls. Okay, coming to the US 10-year yields, we are definitely seeing a pullback happening in the last few sessions, but it is still not out of the woods yet. It could continue to remain range bound, maybe 5.05 on the upside. On the downside, the cool off may take us down towards 4.5 as well. What this means is maybe after a couple of months, this could come back again to haunt us. But at least in the very short to medium term, it seems like the worst is behind us. So the second worry, which is the 10-year bond yields, seem to be not a caution as of now. What is also significant to share here is the Nifty has shown a very strong bounce back after hitting the low of 18,838. As you can see in the graph, this is a crucial support which got tested, and the recovery, in fact the quality of the recovery has been pretty good. We are seeing new leadership emerging, especially from the realty space, which has been witnessing a very long-term breakout. PSC, PSUs have been strong throughout, that continues to stay long, whereas consumption and FMCG, which after a prolonged period of consolidation, now seems to be coming out of the woods, and there is further support which is coming in terms of the Nifty. Now looking at the positional structure of the market, or looking at how or when will the participants go wrong. So if you see this graph, historically whenever we've seen extremes, whenever FI long short ratio has gone below 18, whenever Nifty RSI has gone below 30, and whenever the VIX has shown an extreme range, we have seen markets sort of reversing in a big way. Something similar happened a few days back on the October expiry day, where all three major indicators were suggesting highly oversold nature for the market. As we speak, there are green shoots of short covering by FIs which have been predominantly short on the index futures, vis-a-vis retail which has been predominantly long. And this continues, the way the trend is positioned, it seems like we are at the cusp of a reversal. Now in terms of Nifty, 19,470 is a crucial Fibonacci level above which we think there is a further case for short covering by bears, which are FIs. And once 19,850 is taken out, we would strongly agree that markets are completely entering into a new bull zone, where we may see the Nifty eventually head towards the target of 21,000. So 19,470 is where the bears will go through a stress test, and 19,850 is where we are expecting further long addition, or rather influx of more money into the equity markets, which can take us even higher. So this is where the key to November belongs. Short covering can easily take us until 19,800, which is where the immediate target for the Nifty is. Now the Diwali picks that we've shortlisted for this year are primarily based on one theme, and that is large caps. We've seen mid caps, we've seen small caps have a rally since a long time. We've seen an index go up 40-45% in a matter of months. After that, the cool off. So technically speaking, mid and small caps are the ones where the cool off may continue or selective performance may happen. But what we as a team believe is large caps are at a crucial level where the risk rewards are very favorable, and where we believe there is a big upside that can be had in the coming 12 months. Speaking of the last 36 months or last 3 years, last year Diwali Picks recommended by our team yielded a return of 7% year on year. The return was much higher in between the peak return, whereas the year prior to that, which is 2021, we had a return of 21%, and the Diwali Picks of 2020 had a return of 26%. So 26%, 21% and 7% are the last 3 year returns. This year we expect to break all records, and the way large caps are positioned, will not be surprised if we get returns in the vicinity of around 35 to 40% at the end of the year. Now coming to sectors which look the most robust in this year's Diwali Picks, it is led by the PSU pack, followed by reality, and then we have consumption, which can literally chip in with the additional gains for the Nifty. So speaking of our Diwali Picks, in terms of the portfolio construct, these are top 10 stocks technically where we feel the risk reward is highest in terms of the biggest headroom and the lowest legroom, and some of the stocks can deliver a return of as high as 50% as well. We're very bullish on the PSU pack, which is why we have Gas Authority of India, we have NTPC into the portfolio, and in terms of reality, DLF is our top pick. As we record this, some of the stocks have already gone in excess of 10, 12, 13% after initiating this. We had initiated this at the end of October, just when the markets were selling off in a big way. But we feel that there is still a lot of upside to be had, especially in some of the names that we've shortlisted. So from the IT pack, TCS looks like a formidable bet. We have Tata Motors, which continues to impress and which could see a continuation rally in the coming months from here. NTPC, one of the strongest setups in the PSE space, could very well be headed towards the 300 mark. Capital goods major L&T, that continues to be in our buying list. Because this stock is not done yet. In spite of capital goods having a fantastic rally in the last couple of years, we feel that there is more upside to be had in this one as well. As far as NBFCs are concerned, Bajaj Finance is at the cusp of another round of up move. which can take the stock towards 10,000 on the upside as well. So net, these are the 10 stocks which we advise to buy for an equal allocation. Have a portfolio level stop loss placed at 18%, and around 40% is what we are expecting by the end of this year. Primarily large caps, primarily the sectors which are doing good. We are preferring sectors which are strong, and we are picking on the strength counters which have done well in spite of the Nifty correcting all the way from 20,200 to around 18,800 odd that we recently saw. So we hope that this Diwali Picks brings in a lot of cheer to your portfolio, to your financial health in the new year. And because it is Diwali, and because the situation is such that the opportunity is such that we cannot end this without speaking of gold and silver. These are two commodities which look like they could be a very natural hedge in the first place for your portfolio. At the same time, there could be a new bull run which is probably brewing in silver. So as we speak, gold saw the big breakout, and post that we're seeing it cooling off. As long as this structure remains intact, we are optimistic above $1,900. The chart remains a buy on dip, and there could very well be a strong case for a bounce back or a rebound from lower levels. And at the same time, it also acts as a good hedge in your portfolio. So gold remains a buy on dip. What remains even better is silver. So silver has been into this compression triangle since many months now, the breakout of which can actually take the silver in a big way. We are having big bold targets of lakh rupees for the silver. So one can look to accumulate. It is a volatile commodity for sure. So look to accumulate in a broad range. Stop loss placed at 62,000, and we are optimistic that we should very well see this metal shine up to lakh rupees on the upside. A lot of it also depends on what happens in China, what happens with base metals because of the industrial application of this metal. But the charts are suggesting that possibly something a big move is on the cards. We hope our portfolio, our Diwali picks, and our views on gold and silver benefit you to the most in the coming new year. And we once again wish all our viewers a very happy Diwali and a prosperous new year. Thank you so much. Goodbye. See you again.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.